So, our final discussion this week is about life insurance. So, what is the reason for buying life insurance? It basically enables our family members to continue with their lives free from the financial burden of um, us passing away. So, think of it on several um, needs. Once a person passes away, the family members will have certain financial needs, and the life insurance is intended to cover these needs. So we, define them into, or we categorize them into six categories. The first one is the final expenses. So these are one-time expenses occurring just prior to or after the immediate death. And these expenses are one of the reasons that we should consider life insurance. So there are life insurance that actually just pay for final expenses. I'm sure that you have seen it on TV. There are certain organizations that actually provide these life insurance, specific life insurance for final expenses that pay for funerals and such. But one of the main reasons is the income replacement needs. So if the bread earner in the family passes away, then the income or the lack of that income will become a significant financial burden, and that exposes the family to a financial risk. And life insurance remedies this financial loss. There's a readjustment period needs, and this basically is the after death, the financial loss can be, or the financial exposure can be significant following the death, and therefore the life insurance could cover financially this period. There could be outstanding debts. If the person who passed away is the bread earner, or significant contributor to the family income, certain debts may become unpayable because of the lack of that income. And it could be things such as mortgage, college debt. It could be things such as credit card debts, and lack of that income could render the family in financial distress, and therefore the life insurance is intended to remedy that financial need. There could be other special needs that the that the family has financially, and therefore life insurance can remedy these financial needs. It is such a grim topic to talk about, but from a financial perspective, life insurance is a significant security that remedies needs, and these needs are real. When a person passes away, the family will be faced with these financial needs, and these are definite financial risk exposures to the remainder of the family members. So existing insurance and assets reduce the level of need. So there could be certain levels of insurance that's provided. So for instance, for myself, Loyola University offers life insurance for all its employees. Most employers have a certain level of life insurance offered through work. Premiums are paid through the employer. And so I also have a term life, for instance, not much, but that term life is on top of the existing insurance that my employer provides. And assets obviously reduce the level of need. Unfortunately, many people cannot have enough assets, especially when they're still accumulating their wealth, to reduce the majority of the financial need. In fact, the financial, life insurance is intended to cover unexpected death. So, if you are at the late stages of your life, then the life insurance is usually intended for final expenses, but not to replace your income, not to pay your debts, and so on and so forth. So, in fact, most insurance companies will not cover anything other than financial expenses if you're at the late stages of your life. And therefore, people who unexpectedly die, depending on their age, may not have accumulated enough assets to reduce the level of need. However, having said all of that, existing insurance and assets obviously reduce the level of need. Government benefits can reduce level of need. So Social Security survivor benefits are one of the financial compensations that the family will receive. However, there's Social Security blackout period. So these do change. However, if a person is younger than 40, so an example, a married couple, and they have kids that's younger than 16. The wife is not working, and the husband is working. Husband dies. So the wife will receive survivor benefits until the kid is 16. Now, at that point, when the kid reaches 16, survival benefits will stop for the wife until she reaches the age of 62. That is referred to as the blackout period. So while there is Social Security survivor benefits, the blackout period can be that it actually puts the family at a unexpected financial distress. So if the kid, for instance, is older than 16, then the wife would not have a survivor benefit until she reaches the age of 62. Now, life insurance can close any remaining gaps in financial needs. So this is basically, any existing insurance that you have, any assets that you have will reduce the level of financial need in case of death. And life insurance can and intended to close any remaining gaps in these financial needs. Some terminology: a beneficiary in a life insurance is the person named in the policy to receive the life insurance payment, the funds. And what dollar amount do you need? There are two techniques, two approaches. One of them is a multiple of earnings approach. So again, if you go back to our example, the husband is working, wife is not working, and they have a young kid, then the multiple of earnings simply means that the life insurance will be, say, 5 times or 7 times the annual salary of the husband. However, what happens after that 7 years? So that this actually may have some shortfalls. Needs-based approach seems to work a little bit better, because then we go back to income replacement needs, readjustment period, debt repayment, college expenses, and so on and so forth. So needs-based approach seems to be a little bit more accurate compared to the multiple of earnings approach. But multiple of earning approach is very simple. The person who's insured has, say, $50,000 income, and then say 7 years, so a $350,000 of a life insurance should do. However, that actually may not be sufficient, simply because the financial need may be higher. There are 2 basic types of life insurance. Again, there are different variations of this, and this is not complete. However, these are the 2 basic types of life insurance. There's term life and there's cash value life or accumulating life. A term life is simply a specific face amount, say $1 million, and paid if you die until you're age 65. So most people, when they have a term life, that's what they have, because US retirement age is 62 and 65. And therefore, term life insurance usually runs until either 62 or 65. So based on that, specific face amount is decided based on multiple earnings or need-based. and then a specific time period is decided. That's also dependent on the person, but it's very common to have it until retirement. Premium may go up depending on the term life that you have with each renewal as you get older. But if you are part of an alumni association, part of it, getting this part of your job, part of some sort of affiliation, they may actually have term life insurance arrangements where the premium does not go up. There are different kinds of term life insurance. So decreasing term, basically, right now your financial needs may be $1 million, but 2 years from now, it may not be, maybe even less, because you're actually accumulating wealth, accumulating assets, and making money. And remember that existing assets reduce your level of need. So you may not need the actual $1 million that you took out 10 years ago or 5 years ago. You just need less. So you could actually take out a term life insurance that decreases in value. You could convert the term life insurance in certain types of term life into a cash value. You could buy a term life as part of a group, like I said, like an alumni group, some sort of association through your work, through some sort of affiliation. You could have, these are really rare, but you could have credit term and a mortgage term life insurance that are basically very specialized term life insurance that pay off your credits and mortgages and student loans and such. Based on whatever the amount is for, in case you die. So the second basic type of life insurance is the cash value. This is a permanent insurance, so it's not like the term insurance where it expires after a time period, but it can be. Again, there could be different variations of this. There's a specific face amount and there's a level premium, so the premium does not go up like the term life. And it combines insurance with savings elements. So basically every premium that you make pays for the risk, and it actually has a savings component. So the cash value represents the value of the savings element in the life insurance. Different kinds that are very specific to cash life insurance. There's whole or also known as straight life insurance. There's limited pay whole life insurance, adjustable life insurance, modified life insurance. These all refer to different savings elements that relate to the cash value life insurance. So the specifics of the life insurance policy. Life insurance policy is a written contract between the insurer and the insured, the policyholder. The named parties include the insured, that's you, who are buying the insurance or who are getting the insurance underwritten for himself or herself. The owner, that's the policyholder. A lot of the cases, the insured will be the policyholder, but it can be different. So for instance, some corporations get life insurance for their executives, in which case the policyholder is the corporation and the insured is the executive. Beneficiary is the person who's going to receive the payment in case of death and of the insured. And there could be contingent beneficiaries, which are basically if the first beneficiary dies before the insured, then who is the second or contingent beneficiary. There are different components to a life insurance policy. There are declarations, basically specifics of the life insurance, insuring agreements, if there are any specifics as to, how much, what are the conditions of payment, who to pay, and so on and so forth. There are exclusions, there are conditions, and there are endorsements. We actually see these quite often. Exclusions, for instance, could be that, just as an example, if the life insurance is for a high risk, say, firefighter, and but because of his or her job, the person cannot get life insurance because it's excessively expensive, then they could include it as an exclusion that if the person dies during the job, no life insurance may be paid, which would make the life insurance policy extremely significantly cheaper compared to if you include it and therefore this would be an example of an exclusion. There could be conditions and endorsements or riders in the life insurance, and these are also very, very common. Now, there are some features that are unique to the term life or straight life insurance, and first to die or a survivorship. So, our example, the married couple, husband is working, wife is not working. First to die would be the life insurance that actually pays immediately after the first person dies. Survivorship basically pays after the last. So they have a kid. First to die would actually pay to the wife and the kid, and the last to die would pay both parents die to the kid. And as you can see, the survivorship actually probably would be cheaper compared to first to die. There's incontestability clause, there's suicide clause, and these are very, very common. In the case of a suicide, no payment is done. Incontestability, the same. These are all conditions to the payment, so they apply conditions similarly to the final payment. Cash dividends are basically a refund of excess premium, so this is not a savings like the cash value life insurance. So if there are any excess premium that are paid, they're paid as cash dividends. The death benefit is what is being paid. There's multiple indemnity clauses that are very specific to term life insurances. For instance, you could include it as, a person will get $1 million, but if the person dies out of, I don't know, say radiation poisoning, something, off chance, then you could include a multiple indemnity and then say, if that happens, then the person gets $2 million. Or if the person is murdered, then the other person gets $5 million, and so on and so forth. So you could include different indemnity or certain conditions to life insurance. There could be grace period included into the policy. So for instance, if a policy is terminated because of non-payment, it may be possible to reinstate it on a lapsed policy, although I wouldn't bet on it. So there are some features that are unique to cash value life insurance. So for instance, there's a guaranteed minimum rate of return that could be, not always, but could be. So they become very attractive investment vehicles. There could be non-forfeiture values. You could also get a loan against this, because don't forget, term insurance, term life pays in case the insured dies. That's it. There is no saving component. So most people actually pay till 65, they survive, and therefore term insurance dies. Cash value, on that other hand, it actually has the life insurance and then the savings component, so therefore there's some money actually accumulates there. So you could actually get a loan against this. There could be accelerated death benefits, and this is, sad, but it can happen. But if people have terminal illness, they may want to have certain benefits while they're still dealing with their illness. So a partial payment may be paid in the event of a terminal illness. So this is accelerated death. So just in case, just as a side note, these are not like automatically included in the policies. These are unique term life insurance features, unique cash value life insurance features that you can include, and most of them for an additional fee, additional premium. You could also have waiver of premium. For instance, if you get disabled, your premium could be considered paid without you actually paying for them. So you could get a waiver of premium if you get disabled. And again, you could include this into your life insurance. However, you would probably have to pay extra for this waiver. And then there's guaranteed insurability, which is basically, the ability to purchase additional insurance without regard to your health status. Again, I wouldn't bet on this, but as people age, it gets harder to get life insurance, term or cash value, and it gets more and more expensive. But most importantly, you may not be able to get it. Guaranteed insurability clause will allow you to get additional insurance without going through a health check. This is not as common. However, if you pay for this and include it into life insurance, this is a useful feature. Again, this is specific to cash value life insurance. So when the person dies, the payment is done. However, how is it paid? And this, you could include this into the life insurance. It could be paid as a lump sum. It could be paid as an interest income, a specific amount, specific period income, or income for life. So these are different settlement options that could be included in a life insurance, whether it's a term or a cash value, that while you're negotiating your insurance, life insurance, you could choose one of these settlement options for the payment. Now, the beneficiaries could still negotiate with the insurance company, and then there are other companies that could, underwriting companies that could help you with these payments. So, for instance, if you receive a lump sum, you could go to a third-party financial institution and turn this lump sum into an interest income for a specific amount, income for a specific period, and so on and so forth. So even after the payment is certain, even after death, the beneficiaries can, either through the insurance company or third-party financial institutions, convert these payments into each other. And again, there's so much detail about this chapter, and it really is important to go through the chapter. And if you have any questions, please do let me know. And if there is any specific topic that you'd like me to prepare a video for, please do let me know. Thank you.